Hello everyone, this is ACCA Amit Kumar. I'm founder and CEO of Paramisha Business School, offering ACCA qualification at Dehradun for students willing to pursue ACCA after 10th, 12th, BCom, CIPC, CEC, final, and even chartered accountants. So I am here to share with you how to attempt consolidated statement of financial position question in the new CBE examination pattern. Now, this discussion is applicable to ACCA F7 Financial Reporting, ACCA SBR Strategic Business Reporting, and Diploma in IFRS examination to be held in December 2020 and thereafter. So, how to go about it, how you can practice the same. So, you simply need to go to Google and type DipIFR Specimen Launch Examination. When you type DipIFR Specimen Launch Examination, you simply need to click on CBE Specimen Examination, which will take you to CBE Specimen external site. So when you click on this external site, this will take you to the new examination window on the basis of which this new examination is to be conducted. So here the initial information will be given to you and you will be getting 3 hours 15 minutes of time to read the question paper. So initial 10 minutes are for reading and 3 hours are for attempting the paper. So you'll get 3 hours 15 minutes in total. So general instructions regarding the new examination pattern are given to you, which I discussed in a recent video wherein I shared with you that now you'll be getting a information in terms of exhibits and you need to reply in terms of response options in a spreadsheet and a worksheet. So we'll have a look at a balance sheet question and how to perform calculations in a balance sheet question. So we have the option of a scratch pad. We are given a calculator. We can flag for review any question which you wish to come back again. And before submitting, we can see what all we have done. And then we can finally submit the examination. We can navigate between questions. So we'll be performing the first question, how to do this actually in a real examination, how to use the Excel sheet or a word sheet and spreadsheet, and how to perform a calculation. So we'll review this specimen exam through calculations, and you have an option that when you are appearing for this, you can attempt all the 4 questions. You'll be able to review it, whether you have done all the questions in completion. You can flag them, you can always come back to them. So there are navigation panes which can help you to come back between question 1 to 4. So there are 4 questions, each of 25 marks. And the minimum pass marks are 50. I've been training on IFRS since 10 years now, and I have always believed that if you have gone through the way I share with you the consolidation question, I guarantee you success. And my belief says that if you understand it well, you've already passed. If you understand the way I do it, your 50 marks are guaranteed. You simply need to decide how many marks you wish to achieve between 50 and 100. So that's the only fight left after going through this discussion. So all the best wishes. So with this, let's launch into a new era of attempting an examination. Though I've been doing the same since 10 years, since I've been training participants on the Excel sheet and I've been sharing that Excel sheet since 10 years now. So I think ACC has done a favor that the practice which I've been doing of calculating the balance sheet question in Excel sheet is finally helping me to share those insights which I've gained and how to attempt it in the real examination, which has changed for you. So I shared a video to welcome the change, and let's welcome the change in real sense. How to actually attempt it. So as I say, so whenever we begin a question, the first thing we need to do is read the requirement. Don't jump onto the conclusion looking at the information that you have to do something. Don't do so. First read the requirement. Be cool and calm. Simply enjoy the process. So using the draft financial statements of financial position of alpha and its subsidiary beta. Now there is a parent known as alpha, there is a subsidiary beta. At 30th September 2007 in Exhibit 1. Exhibit 1 here is the note, and the further information is provided from Exhibits 2 to 4. Prepare the consolidated statement of financial position of alpha at 30th September 2007. Now here there are two things we've got. We've got the parent is alpha, subsidiary is beta, the date of reporting is 30th September 2007. We'll need this information. Next thing will be, so we need to prepare a statement of financial position, that's clear, and the response option available here is a spreadsheet. We are given the draft financial statements of alpha and beta. So the moment you look at the draft financial statements of alpha and beta, since we need to prepare consolidated financial statement, the first thing to be done by you is copy paste this content, because you cannot make any changes in it. In this sheet you cannot make any changes, so better it is, let's copy it and take it to the spreadsheet. This is how the spreadsheet will look like. Paste it here. When you paste it here, some of the figures may not come as clean as we want it. So simply use the features of cut and copy and spread them as you want it. Now they look clean and clear now. So this is the status. Now when we are preparing consolidated financial statements, what do we need to do? We simply need to replace the individual financial statements with consolidated statement of financial position as on 30th September 20x7. That's the expectation. Now we cannot insert anything in the middle. We cannot insert any statement in the middle. So better it is that we copy paste. We use copy paste. We become familiar in copy paste as much as possible to navigate. So leaving some space here, you copy paste it. Now we'll need information here. This investments in Exhibit 2 will be replaced with goodwill. This share capital, retained earnings will be replaced with other components of equity. So let's leave some space here. Let's create some space here. We increase the size as per convenience. Make it equivalent so that it becomes visible to you and you don't have any problem doing it. So there is property, plant and equipment is Exhibit 2 for it. Alpha's investments will be reading it shortly. Inventories are given to us. There is an Exhibit 3 relating to the inventory. There may be some intragroup trading which we need to deal with it. Cash and cash equivalents are related to intragroup trading of Exhibit 3. Equity and liabilities, share capital of parent, alpha and beta is given to us, and we'll be rounding it to 1000. So that means we need to present the financial statements of alpha plus beta. This is what we'll be doing. We'll be adding up the financials of alpha and beta in the property, plant and equipment. Investments will be replacing it with goodwill, and there are long-term borrowings, deferred tax. Everything is simple. There's other components of equity as well which we need to deal with here. So next thing is read the requirement. Alpha's investments. Now we have options of highlighting it here and strike through. Now in the spreadsheet, As I've always mentioned, that we simply need to divide the question into 5 workings. And if you know these 5 workings, you can easily perform any question anywhere in the world. So the 5 workings are proof structure, leave some space and give some space to net assets of subsidiary, and we need to present these net assets of subsidiary on date of acquisition, date of balance sheet. Date of balance sheet is provided to us, which is 30th September 20x7. What we need is date of acquisition, which we get from Alpha's investments. On 1st October, Alpha acquired 90 million shares in Beta. Now this information I'll be needing in working note number 1. So I have 5 colors here. So I think we can use these colors as workings. Like if I highlight this yellow, I'll be using this information in working note number 1. If I highlight it with green or pink or blue, I'll be highlighting them for working note number 1 to 4. And 5th, we can keep the white space we can keep for working note number 5 as group retained earnings. So when I highlight this, 1st October 2004, Alpha acquired 90 million shares in Beta. This will help me to know that this is the information to be used in working note number 1. And 90 million shares in Beta. When I say 90 million shares in Beta, we can say how many shares are there in Beta's financial statements. 90 million. There are 120,000 shares. So 90 million here will be 90,000 since we are rounding it to 1,000. So 90,000 shares out of 1,20,000 shares belong to Alpha. So Alpha has acquired 90,000 divided by 120,000 into 100, and they have acquired them 90,000 divided by 120,000 into 100. 75% is the Alpha's investment in Beta. Beta is the subsidiary. The date of acquisition of Beta is mentioned here. 1st October 20x4 is the date of acquisition. 1st October. The best part is that even if we close this sheet, whatever we have typed in it gets automatically saved. So that's a thank you sign from ACCA that whatever you have done gets saved and you do not have to worry about saving it again and again. So when I click on this, 1st October 20x4 is the date of acquisition. Date of balance sheet, I should give information as 30th September 20x7. So these are the first information we should be providing in working note number 1. We should scan through the question, Alpha's investments. Now, the investment in Beta is 2,36,500. There are other equity investments. Now these other equity investments, if you look at, belong to which category? The other equity investments, these investments are classified as fair value through P&L. The fair value of these investments at 30th September 2007 was 13.8 billion. So if you look at it here, the other equity investments are 13,000 and they increased to 13,800. So if I have to make this change, we can easily make this change here, that in consolidated financial statements, this investment amount will be replaced, and this will be replaced with the new investment amount of 13,800. Investments are valued at 13,000. Out of this 2,49,500, 13,000 will be 13,800 since they are measured at fair value. So we can mention here that other investments are measured at fair value. Other investments are measured at fair value through P&L. So they were valued at 13,000 and remeasured on 30th September 20x7 as 13,800. So this difference of 800 will be recording as part of profit and loss account in working note number 5. So we'll be taking this difference of 800 as working note number 5 group retained earnings and will be recorded as FVTPL at fair value through PNL in working note number 5. The second thing we need is net assets of subsidiary, that is on date of acquisition and date of balance sheet. Now this is date of balance sheet. Date of acquisition is 1st October 20x4. Now net assets of subsidiary we acquired. So net assets of subsidiary which are acquired are share capital, retained earnings, other components of equity. Other components of equity, there is nothing as far as subsidiary is concerned, so there is only share capital and retained earnings on the date of acquisition. So share capital on the date of acquisition is 1,20,000, 1,20,000, which is the same on the date of balance sheet, 1,20,000. The date of balance sheet figure of retained earnings is to be picked from here. Retained earnings are standing at 1,68,000 on the date of reporting. So 1,68,000 is the date of reporting. How much is the value on date of acquisition, which we'll get from? So this was acquired by means of a share exchange of 2 shares in alpha for every 3 shares acquired in beta. Now this information of 2 shares in beta multiplied with 3 shares in beta will be needing it in working note number 3. So we can highlight the third. This information I'll need in working note number 3. On 1st October 2004, the market value of alpha share was 3.90. This information again I'll be needing in working note number 3 for knowing the value of these shares. I'll need this information in working note number 3. Alpha incurred directly attributable cost of 2.5 million on acquisition of beta. Alpha included these costs on the carrying amount of investment in beta in its own statement of financial position. These costs comprised 1 million cost of issuing on shares and 1.5 million due diligence cost. Now this 1 million cost of issuing own shares should be deducted directly from equity, and this 1.5 million due diligence cost should be charged as an expense in profit and loss account of the parent. But what they have done, they've actually capitalized this 2.5 million as part of 236,500. So if I remove 2.5 million from here, the remaining value turns out to be 2,34,000. So the fair value of these shares should be equivalent to 2,34,000. Or we can first calculate the value of these shares. So if I go to working note number 3, let's open up working note number 3 all together here. We need calculation of goodwill. Now in calculation of goodwill, we'll be needing this information of purchase consideration. And purchase consideration is these shares acquired. So we have acquired 90,000 shares by means of a share exchange for every 2 shares. Now 2 shares were issued for every 3 shares acquired in beta. So if 90,000 shares are issued, for every 3 shares, for every 2 shares, 3 shares are issued. Read it again. Of 2 shares in alpha for every 3 shares acquired in beta. For every 3 acquired in beta means 90,000 divided by 3 into 2. It means the purchase consideration is equivalent to, and the share price of alpha's share is 3.90 multiplied with 3.90. So 90,000 divided by 3 is 30,000. 30,000 into 2 is 60,000. 60,000 into 3.90 turns out to be 2,34,000. 2,34,000 is the purchase consideration being paid. Then we'll need value of NCI. Value of NCI here is non-controlling interest. Value of non-controlling interest. The second question we need to ask is whether this non-controlling interest is valued on fair value basis or on proportionate basis. Just quickly scan. On 1st October 2004, the directors of Alpha initially measured the non-controlling interest in beta at fair value. The fair value of equity share in beta, which can be used to measure the fair value of non-controlling interest. This information again will need in working note number 3 for valuation of non-controlling interest. I'm highlighting it so that we can know what we have done and what is yet to be done. So 2.35 is the value of each share, and if we have acquired out of 1,20,000, if you have acquired 90,000 shares, how many shares belong to non-controlling interest? 30,000 shares, and the value of each share is equivalent to 2.35. 2.35 is the value of share. 30,000 multiplied with 2.35 non-controlling interest is worth 70,500. Hereafter we'll need fair value of net assets of subsidiary on date of acquisition, which we'll be getting from working note number 2. We'll be referring to working note number 2 for it. Let's complete the working note number 2. So retained earnings position, let's read it further. This will be treating as part of other components of equity and will be treating as part of working note number 5. This will be treating as part of working note number 5, 1.5. So let's leave it for now. Let's begin from 1st October 2004. The individual financial statements of beta showed retained earnings of 60 million. 60 million means the retained earnings position on the date of acquisition was 60,000. Then we read further. The directors of Alpha carried out a fair value exercise to measure the identifiable assets and liabilities of beta on 1st October 2004. The following matters emerged. There is a freehold land which had a carrying amount. So this paragraph we can easily say that this is belonging to working note number 2. You can highlight it with green that this area belongs to working note number 2. Directors of Alpha carried out a fair value exercise to measure the identifiable assets and liabilities of beta on 1st October. The following matters emerged. Freehold land which had a carrying amount of 150 million had an estimated fair value of 210 million. So how much is the increase in fair value? And that land was still owned by beta on 30 September 2007. So 150 million increased to 210 million. There's an increase of 60,000. So we'll be dealing with fair value adjustments. Fair value adjustments. In it we'll be dealing with land which has a value of 60,000 on the date of acquisition and 60,000 date of balance sheet because they're still owning this land. Plant and equipment having a carrying amount of 121 million had a estimated fair value of 145 million. So what is the total difference? 145 minus 121. Plant and equipment. And the estimated remaining life of this plant on 1st October 2004 was 4 years. Now we acquired it on 1st October 2004 and we are on 30th September 2007. That is 2004 to 5, 5 to 6, 6 to 7. 3 years have already passed. 1 year's amount is yet to be consumed. So out of 145 minus 121, plant and equipment plant and equipment 145 minus 121 that is equal to 24,000, and 24,000 is depreciated. 24,000 is to be depreciated over a period of 4 years. 3 years depreciation have already passed, so only 1 year's depreciation is left. So 3 years depreciation have already happened on this plant and equipment. There's a total increase of 15 plus 9, 24, 4 years life, that means 6,000 depreciation every year. 3 years have already passed, 1 year depreciation pending. Remaining life was 4 years. So this is the final year. So on date of balance sheet on 30th September 2007, the value remaining is 6,000. A brand name relating to Beta had a fair value of 25 million. This brand name was not recognized in the individual financial statements. Now, according to IFRS 3 business combinations, whenever we acquire another entity, we are required to fair value the net assets. That's what we are doing here. And in doing so, we may identify some of the intangible assets which may emerge for the first time on the date of acquisition. Now, in this, we got to know a brand which has a value of 25 million. It was not recognized in the individual financial statements since it was internally developed. The directors of Alpha considered that the useful life of this brand was 25 years from 1st October 2004. So we'll include the value of brand as well at an amount of 25,000, and this has suffered 3 years depreciation. That means 25,000 divided by 25. 3 years depreciation have already been suffered. That means 22 years of depreciation is yet to be recovered. So the value on the date of balance sheet, 3 years depreciation in a 25,000 asset, 3 years depreciation is 3,000. 25,000 minus 3,000, it is equivalent to 22,000. Let's read further. The fair value adjustments have not been reflected in the individual financial statements of Beta, so we've already done so. In the consolidated financial statements, the fair value adjustments will be regarded as temporary differences for the purpose of computing deferred tax. The rate of deferred tax to apply to temporary differences is 20%. So deferred tax applicable is 20%. So the total sum is 60,000, 24,000 plus 25,000. 21,800 is the deferred tax liability to be included in the net assets or subsidy on the date of balance sheet. So the land is increased by 60, plant and equipment by 24,000, and brand has increased by 25,000. This indicates that we are going to earn more in future. If you're going to earn more in future, we'll be liable to pay more tax in future. And if we are expecting to earn in total 1,09,000 in future, if we are expecting to earn 1,09,000 in future, and if the rate of tax is 20%, we'll be liable to pay around 20% of 1,90,000, which approximately 20% of 109,000 is 21,800. So that's what I've included here as part of deferred tax liability. The same figure will be calculated here. The deferred tax liability on date of balance sheet will be 17,600. You simply need to copy paste the formula from here. So that's the way our life has improved. As I was saying, that we simply need to copy paste, and we should note the concepts. As far as accounting is concerned, we should be clear with the concepts, then only we'll be able to do accounting properly. So when we total up, the total net assets position on date of acquisition is 267,200. The same I can copy paste here. I'll get to know the balance on date of balance sheet, that is 358,400. Post acquisition earnings are 358,400 minus 267,200. The balance is equal to this minus 267,200. 91,200 is the post-acquisition earnings, in which parent has a share of that is Alpha has a share. Alpha's share, which we need to include in working note number 5, is 75% of 91,200, which turns out to be 75% of 91,200. NCI share, non-controlling interest share, we need to present in working note number 4, that is 25% of 91,200, which equals to 25% of 91,200 is 22,800 to be included in working note number 4. This is how we'll be dealing with post acquisition earnings. In working note number 2. Working note number 3 is for calculation of goodwill. Now we have got the purchase consideration, we have got the value of NCI. We simply need to pick up the value from net assets of subsidiary on date of acquisition 267,200, and we can know the goodwill now. The goodwill amount is equivalent to 234,000 plus 70,500 minus 267,200. 37,300 is the goodwill amount. This is to be included. This will be replacing this investment figure, and goodwill amount to be presented will be equivalent to 37,300 will be the goodwill amount. Alpha's other investment is 13,800. Total investment of Alpha is 236,500, out of which 2,34,000 we have catered to, 13,000 we know, 2,500 is here in 1 million cost of issuing on shares and 1 million due diligence cost. So once you have done this, you can strike through all these that we have dealt with all of these, except these we are yet to deal with them. This we have dealt with, so we can remember that this is what we need to cater to yet. This we have dealt with. This is yet to be done. You dealt with this information as well. So you can remember that this is yet to be done so that we can take care of it when we are dealing with the transactions. So exhibit 2 is done. Exhibit 1 we have copy pasted it as part of our spreadsheet. Exhibit 2 is done. Then there is intra-group trading. Alpha provides Beta with management services and levies a monthly charge for these services. On 29 September 2007, Beta made a payment of 8 million to Alpha to eliminate the amount owing to Alpha at that date. This payment was received and recorded by Alpha on 2nd October. So Alpha provides Beta with management services, and Beta has made a payment of 8 million, which is cash in transit. So the intra-group trading to be dealt with is relating to exhibit 3 is Alpha plus Beta. Now this 140 plus 85 and 95,000 plus 70,000, this will be presented like this: 95,000 plus 70,000. The receivables is assumed to have been received this amount of 8,000. So minus 8,000, that is exhibit 3. Cash and cash equivalents will be 16,000 plus 13,000 plus 8,000 in the assumption that as if the cash has been received. This is because of working note number 3. So cash in transit is treated as if the cash has been received, and if cash has been received, we'll reduce the trade receivables and will assume as if cash has been received, so we'll increase the cash and cash equivalents. So this is exhibit 3, so I'm marking it here. This is the treatment for exhibit 3 for intragroup trading. Remove these totals because these are going to change now. Property, plant and equipment will be 73120 plus 731,200 plus 310,000 in it. The amount which was included in working note number 2 for land 60,000 will be added on the date of balance sheet, that is 30 September 2007. Land is added at 60,000. So 73120 plus 310,000 plus 60,000, and we can mark it as working note number 2 plus plant and equipment as 6,000 plus 6,000 again from working note number 2 as plant and equipment. Now this is for 60,000 is for land, 6,000 is for plant and equipment. Brand is for 22,000, so it will be presented as intangible asset. Brand, working note number 2 as 22,000. So total of alpha plus beta for property, plant and equipment is equal to 731,200 plus 310,000 plus 60,000 plus 6,000 is the total value of plant and equipment included. That is 110,7,200. The investment to be included is equal to 13,800. The goodwill amount to be included is 37,300. So these are the amounts to be included as part of 13,800, 37,300. Inventories are added as 140 plus 85,000, 140,000 plus 85,000 equivalent to 140,000 plus 85,000 is the valuation of inventories. Trade receivables are equivalent to 95,000 plus 70,000 minus 8,000. Cash and cash equivalent is equivalent to 16,000 plus 13,000 plus 8,000. Total assets, it will be only share capital of parent only. Share capital of parent only. We'll be presenting with group retained earnings. We are yet to calculate this. Other components of equity, you are yet to calculate this. Long-term borrowings, we can say as 100,000 plus 70,000. 100,000 plus 70,000. $170,000. We'll deal with it when we are dealing with deferred taxes. Deferred taxes we can deal with it. 59,000 plus 38,000. 59,000 plus 38,000 plus the balance of deferred tax included in the date of balance sheet is 17,600 plus 17,600. This is 100,000 plus 70,000. So total amount of deferred tax balance is 59,000 plus 38,000 plus 17,600. Current liabilities are trade and other payables 60,000 plus 52,000. plus 52,000. Short-term borrowings 20,000 plus 30,000. These are free marks. I call them free marks. Do not forget to gain them. 20,000 plus 30,000 is 50,000 of short-term borrowings. We are left with replacing group retained earnings and other components of equity. Group retained earnings will be working note number 5. We'll need space for it. Non-controlling interest. Working note number 4. So we'll see if there is any impairment of goodwill because we valued NCI at fair value. So if there is any impairment of goodwill, so there is no information regarding impairment of goodwill. We have share-based payments, so we'll deal with share-based payments question once we have dealt with working note number 4, working note number 5. We'll see to it. So exhibit 2, exhibit 3 is done. Let's move on to complete working note number 4. Working note number 4 is non-controlling interest. Value of NCI on date of acquisition. Value of NCI on date of acquisition is in working note number 3, which is equivalent to 70,500 plus share of profit of NCI. This is presented in working note number 2, equivalent to share of profit of NCI in working note number 2, that is 20,800. So total amount to be included in NCI's valuation is equivalent to 70,500 plus 22,800. 93,300 is the value of NCI. So valuation of NCI included is 93,300. Then we'll need group retained earnings, working note number 5. Working note number 5 is group retained earnings, which means parents' earnings plus share of profit from subsidiary beta, we get it from working note number 2. Parents' earnings are equivalent to 5,50,000. 5,50,700. 5,50,700 is the parents' earnings. Share of profit of subsidiary is 1,68,000, out of which share of profit is decided now. From working note number 2, share of profit of subsidiary is post acquisition profits, that is 68,400. Then there are less due diligence costs, which are to be deducted from Alpha's investments. If you remember, due diligence costs of 1.5 million are to be included. That is minus 1,500 to be included from due diligence costs. Working note number 6 says other components of equity. In other components of equity, it is at 202,000. 202,000 is the balance. 202,000. From it we'll deduct issue costs of shares is equal to minus 1,000. Alpha incurred directly attributable cost of 2.5 million in acquisition of Beta. Alpha included those costs on the carrying value of investment in Beta in its own statement of financial position. These costs comprised 1 million is cost of issuing shares. Now this is to be deducted from equity. So here we have other components of equity of Alpha, from where we'll deduct this 1 million. And 1.5 million is due diligence cost, which is part of expense of the parent. So we included it as part of working note number 5. So we've dealt with all the notes now. So you can strike through all of them. So if you look at it here, we have dealt with all. So this saves your time. You do not have to worry about coming back to this sheet again and again, and you can be assured that you have completed this. Now we are left with only to be dealt with share-based payments. Now when you look at this information of share-based payments, we get to know that on 1st October 2005, that is 20x5, Alpha granted 200 senior managers options to buy 100,000 shares each between 30th September 2008 and 31st December 2008. So this is after 3 years. The options are due to vest on 30th September 2008, provided the relevant managers remain employed over the 3-year vesting period. Ending on that date, on 1st October 2005, the expectation of number of managers in whom the options would vest had varied. On 1st October, the expectation was 200. On 30th September 2006, they turned out to be 180. On 30th September 2007, the expectation is 190. So when they reached 30th September 2006, they were to be spread over 2006, 2007, 2008, 3-year period. In preparing the financial statements of Alpha for the year ended 30th September 2006, the directors of Alpha debited retained earnings and credited other components of equity with the appropriate amount required by IFRS 2 share-based payments. The directors of Alpha have made no additional entries in respect of this arrangement in the draft financial statements for the year ended 30th September 2007. And on 1st October 2005, the fair value of one option was estimated to be 1.20. The fair value of same option on 30th September 2006 and 7 are 1.25 and 1.30. Then in case of share options, we always take the fair value on the date of grant. So we'll leave this 1.20 as the fair value on the date of grant. There are 100,000 share options, 200 senior managers. So the total cost of share options will have a working note number 7 for dealing with share-based payments. Total expense under 100,000 share options is, that is 100,000 into 200 senior managers, and the price of each is 1.20. This is the cost, 100,000 into 200 into 1.20 is the total cost for 3 years. The cost for 2 years have been charged or credited to equity. That is, this is representing 3 years, and the cost of 2 years have been charged. The liability now is that on 30th September 2007, the expected liability is, this is the expectation on 30th September 2006. On 30th September 2006, the expectation was that 180 will exercise the rights. Out of 200 senior managers, 180 will exercise the option. If 180 are going to exercise the option, the cost recognized by the end of 30th September 2006 is for a 3-year period. First year cost has been recognized. So this will be 100,000 into 180 into 180. Cost for year 2006 has been charged, which turns out to be equivalent to, this is the cost for 3 years, and 1 year cost has been charged. The liability changes now, not the liabilities, the equity reserve changes now, at 100,000 share options. Now the expectation is that 190 will be exercising the right, and if 190 will be exercising the right, the total cost which will be expensed off will be 100,000 into 190 into 1.20. So the cost for year 20x6 and 20x7 is equivalent to, this has to be spread over 3-year period, and 2 years have already passed. The cost which should be recognized till date will be 152,000, and the cost which have already been charged is 720. So the difference we need to charge 152 minus this difference we need to charge for this year, rounding to 1000, this becomes 8,000. I'm in the habit of saving it, since in my classes I save the Excel sheet and share it after the session is over. So I'm in the habit of saving it, is the reason I end up pressing Ctrl S again and again. So you don't commit this mistake. So the entry to be passed is expense account, debit, equity reserve account, credit is 8,000. So 8,000 is to be included for share-based payments. Working note number 2, which is equivalent to 8,000. So the total amount to be included is 202,000 minus 1,000 plus 8,000 is equivalent to 209. So we'll be including other components of equity as working note number 6. The total amount to be included is equivalent to 209,000. So total assets value is equivalent to sum. The total of all these figures is 1599300. This is the total value of all assets. And the total value of liabilities, total value of equity plus liabilities, current liabilities is equivalent to the sum of all these figures, which is equivalent to 988,900, in which we have to include group retained earnings of working note number 5 at an amount of working note number 5 total will be. So there is share-based payment expense to be charged. Share-based payment expense, which is equal to 8,000. The total of all these equivalent to 609,600. Equivalent to 609,600. Other components of equity at 209,000. Non-controlling interest to be measured at 93,300. Share capital of parent only, that is 2,40,000 we need to include. Group retained earnings is standing at 5,50,700 plus 68,400 is working note number 2 minus 1,500 minus 18,000 is equivalent to 609. There is an amount of 800 which is the difference. This amount of 800 is to be included as part of working note number 5, which you have not included yet. It is, so the only way we have is change in fair value of investment. So we have included this change in fair value of the investment on debit side. I included it at the very beginning of our question, 13,800. This investment was at 13,000, but we forgot to add it by the end of the year. That is in working note number 5. So always make sure that when you make this adjustment here, immediately open up these 5 workings. Now when we open up these 5 workings together, I think we'll not be committing any mistake. And even if you do, you'll be able to know this difference. Like I have got to know now that I have committed a mistake here, that I did not include the change in fair value of this investment. Now the change in fair value of this investment is standing at 800. So if we include this change, I get to know that the total of all these investments in working note number 5 is 610,400. So the amount to be included is 610,400, and we have been successful in preparing consolidated statement of financial position as on 30th September 20x7. The total of assets is 15,99,300 and total of equity and liabilities is 15,99,300. Now this is time for celebrations that we have been successful in performing a consolidated balance sheet question perfectly well. Hopefully you'll be easily able to do it. If you have any concerns, you can reach out to me so that I can try my best to make your life easier to easily pass any examination based on session CBEs. Now this guidance can be applicable to ACCA F7, ACCA SBR, and definitely for diploma in IFRS. Anyone willing to appear for diploma in IFRS can easily pass through these 5 workings. So with this, I come to the close of the session. Thanks for your valuable time.